Good day. Welcome to today's talk about the preparation and submissions of the ITR14s. My name is Johan Heidenrug. I'm a partner at KPMG. Those of you that have attended or participated in last year's lecture with the same topic, we have changed the contents slightly, even though the basic principles of the lecture is the same. But we have taken a different case study, and we are focusing this year a bit more on fixed assets, the new legislation on doubtful debts, and we are taking a new set of financial statements that we are analyzing. So for the next 3 hours, hopefully we will make a bit of an impact regarding the importance of the ITR14 preparations, and hopefully as a profession we will grow further. So the objective of this training is the importance of tax compliance. I have started doing tax in about 1992, and at that stage tax compliance was very much a non-event. It was very much, if you made a mistake, you could go to SARS and fix it. These years it is absolutely different. The Tax Administration Came Act. The tax administration is quite onerous with regards to your responsibilities as a tax practitioner, and it is important that one gets it right the first time. Even though we've got quite nifty legislation regarding dispute resolutions, it's simply too dragged out, and one do not want to get into that arena. As never before, it's been so important that before you press that submit button, that you make sure that everything is correct. Also, in the past, there was no registered tax practitioner role, and as such, us as a profession, as tax practitioners, we need to be quite clear and consistent in the way that we treat our responsibilities towards the SARS, towards the profession, and towards our clients with regards to our roles in preparing the tax returns. So the whole idea is that we'll look at the importance of tax compliance, and then last year I also introduced this, but I'll have a brief discussion again about the phased approach on the ITR14 completion. It is not just simply let's just jump in and do the tax calculation and the tax return. There's 8 phases that I believe one should follow, and once you've completed all those 8 phases, we will elevate the importance of the ITR14, and we will actually comply with our obligations in terms of the Tax Administration Act. And then we'll go through the ITR14. I'll briefly look at some of the yes-no questions, what have changed in the last year, and then we'll talk, most of the lecture would be about technical issues, commonly found errors, particularly focused on fixed assets, doubtful debts, and some of the others. And then also just anticipating a tax audit, anticipating an ITR14 SD. So the main topic of today's discussion is what is the responsibility of the tax practitioner? So the tax practitioner's responsibilities with the ITR14 is to make sure that complete and accurate information is submitted to SARS, and that defendable positions are taken whenever there are tax uncertain positions. And there's a difference between a tax uncertain position and tax illegal position or tax aggressive position. In every single tax return, there is a tax uncertain position. And it is important that one identifies that and make sure that defendable positions are taken. So it is not just an administrative function. So this course is developed to assist the tax practitioner in exercising reasonable care when preparing the ITR14 tax return. Commonly found misconceptions. In practice, there are commonly found misconceptions. The one that I arrive at most is that the clients or the tax practitioners themselves will say, well, I can rely on the tax calculation as prepared by the auditors. I can rely on whatever the tax calculation is in the financial statements. So I have 2 different scenarios that I find. On the one side, somebody will just prepare the tax calculation purely based on what's happened in the financial statements. At the other side, they'll totally ignore the financial statements and just do their own. The accurate one is to take the financial statement calculations as a basis but then do more work. But you can't simply accept it. And the reason for that is the audit is concerned about reasonability. When you do the tax return, you can't just think about reasonability. It needs to be accurate. It needs to be complete. The audit is based on what materiality is. Also, the audit is more concerned about what the net number between normal tax and deferred tax is. The auditor is not that concerned if you did not add back all the provisions, because if you add back a provision, yes, your normal tax liability will go up, but your deferred tax liability will go down with the same amount. So the auditor is more concerned about what we call non-temporary differences, which will have an impact on the equity of the financial statements. Also, the audit is generally prepared very quickly after year end. You do not have full analysis of things like consulting fees, legal fees, and the like. And ironically, the auditor relies on the work that the tax practitioner does. Now, if the tax practitioner relies on the work the auditor does, who takes the ultimate responsibility? Particularly the auditor will rely on the work the tax practitioner done with regards to the prior year numbers. For the current year numbers, it is all in materiality. So you can't just simply rely on the work that the auditor has done. This one is a very important one. Historically, there's a perception that, let me just make full disclosure and SARS can decide whether they want to accept it or not. I often get clients says, well, SARS have accepted this forever. That doesn't help you. In the current system, the ITR14 is a system of self-assessment. You submit the ITR14 and the only supporting information you submit is the financial statements. In the olden days, we used to prepare a big file, deliver the big file with SARS, provide all kinds of information, and then SARS has to sift through that and decide what is deductible or not. Now in the ITR14, you don't provide all this information, and there's an automated assessment, and there's no human being going through the ITR14 unless there is a request for information or an audit. So the mere assessment process is not an assessment after a review by a human being. It's an automated process. So it is a self-assessment system. It's nothing more than a self-assessment system. And if you get it wrong, you will be liable for understatement penalties that I'll discuss a bit later. So you can't simply accept, well, SARS have accepted it historically, and they should accept it again. If you do not have a binding private ruling or binding class ruling, you simply need to make sure that every year it stands on its own. This one is, I often find, is the tax compliance is simply administrative function. The days when a client will be happy that you can accept and do a tax return for 4, 5, 6, 7,000 rand, those days are absolutely gone. It is important that the tax practitioner that does the tax compliance work has got strong accounting skills. Even when you do not comply with full IFRS, even if you comply with IFRS for small and medium enterprises, the distance between the accounting and tax concepts is just becoming wider on an annual basis. Half your work is just to unwind whatever the accountants have done. Half your work is to understand whether there has been a fair valuation, whether there has been a business combination where the take-on balances have been changed, whether the IFRS 2 share-based payment has found its way in your salary number. You can't just rely on something that says salary, that it is just a salary. It may be an accounting adjustment in there. You can't rely that something that is called interest is interest. It may be a fair valuation of an interest-free loan where there's notional interest in there. So you have to understand the accounting before you can do the tax, because half your work is unwinding the accounting. You have to have a strong and a broad-based tax skills. So for example, when you look at the financial statements, and on the financial statements, there is a loan to a director, an interest-free loan to the director. Classically, there is no interest, there is nothing, so it does not necessarily impact the normal tax calculation. However, within just that one item, there are numerous other considerations that you may have. Firstly, is the director an employee? If the director is an employee and that loan is for services rendered, then you may have a fringe benefit. And the fringe benefit, you may have to tax the fringe benefit on the tax. Now you may say to yourself, well, I'm not tasked to do the employment taxes. But you can't turn a blind eye as a professional to this obvious error. The other one is maybe the director is a shareholder. If the loan was given to a shareholder, you need to consider we've got a deemed dividend, and you have to withhold deemed dividend on a deemed interest inclusion. So you can't simply just say that one item has got a fringe benefit implication, it's got a deemed dividend implication, and as tax professionals, our clients expect us to advise them of all of these concerns. As you go through the fixed asset register, you may find that on the fixed asset register, there is a Range Rover or a BMW X5 on the fixed asset register. And you need to ask yourself, but hang on, who's using this vehicle? Is this truly a pool vehicle? Is this not a vehicle that is used by the managing director? And again, is there a fringe benefit impact? If there's a fringe benefit impact, you have to consider that there's an output VAT liability. And these things are numerous. And that's why I'm saying the tax practitioner has got an envious task. If you are a tax senior counsel or a tax lawyer,